Although triple tops and triple bottoms are similar to head and shoulder patterns, but these patterns, triple tops and triple bottoms, are very rare into market. But one of the most common pattern and one of the most widely traded pattern is double tops and double bottoms pattern. A much more reversal pattern, it is most frequently seen and easily recognized pattern. A double top is mostly referred to as an M because it looks like an M, whereas a double bottom pattern referred to as a W because it looks like a W. General characteristic of double top and double bottom pattern is similar to head and shoulder pattern, like volume interpretation, breaking of the trend line, and how volume picks up. Except the only two peaks appear instead of three, where in double top, where in head and shoulder pattern there are three peaks, in a double top pattern there are only two peaks. Similarly, in a inverse head and shoulder pattern there are three bottoms, in double bottoms there are only two bottoms. Volume pattern is similar as is a measuring rule. Following is an example of a double top pattern, and you can see prices are moving towards upside in a non-overlapping fashion before price at point C decides that it is not interested to go upward anymore and comes down and breaks the trend line, comes further down and breaks below the bottom of point B. This is very important. For a double top to form, the prices must break below the bottom of point. Prices have to break below the bottom of point B for a double top to confirm. Once prices broke below the bottom of point B, prices will retrace back to a line to the bottom of point B before reversing. The retracement, which is also common in head and shoulders and triple tops and triple bottom patterns, prices tend to retrace back to the neckline in head and shoulder pattern, whereas here prices tend to retrace back to the bottom of point B when you're dealing with double top pattern. Once prices find resistance at the bottom of point B, prices reverse and start going in the newfound trend. Similar and exact opposite is the case with double bottom pattern. A double bottom pattern is made on its left hand side. You will find a zigzag non-overlapping downward moving wave pattern, and suddenly prices decide they are not interested in making new lows anymore, and volume supports their view by lower volume recorded on when prices reach second bottom or when prices reach the level of first bottom, and then prices reverse and breaks the trend line. Once trend line is broken, prices go ahead to trade above the point, the newest peak or the middle peak, the peak that lies between these two bottoms. Prices go ahead to trade above this peak. They trade above this peak, come back and test the level of peak, and then they reverse. Start going upside and start making upward non-overlapping waves. And volume suggests the view by increased volume on the upside and volume shrinking whenever prices or retrace or pulls back. An ideal double top has two prominent peaks. Volume tends to be heavier on first peak and lighter on second peak. A decisive close below the middle throw on heavier volume completes the pattern and signals a reversal of the trend to the downside. Now in double top and double bottom patterns, prices tend to be more volatile as compared to head and shoulder patterns. So the retracement back to the peak or throw, the middle peak or throw is not always found. When prices break through the peak or throw of these patterns, the price move that follows is much more volatile. Let's go ahead and take a look at an example. Following is a daily chart of PPCL, and you can see PPCL has made a double top, a somewhat double top. You cannot call it a true double top, but you will not always find a true double top in market either. As long as the close of the second top is below its the highest level of previous top, we can safely assume that this can be a double top. And you can see a break below the throw of the throw that lies between these two top concludes that the double top pattern is complete. At this close, the pattern is completed and a downward move ensues from here. Our next chart is a CAT limited daily chart. You can see prices are moving downside on the left hand side, and then prices find resistance at the level of, prices find support on the level of 500, move up, comes back to the level of 500 and reverses, breaks through the middle peak, suggesting that this is a double bottom formation. Once prices have closed successfully above the peak, double bottom pattern is complete and prices start moving towards the upside. Measuring technique. The measuring technique of these double top and double bottom pattern is similar to the measuring technique of head and shoulder pattern. The height of the pattern is projected from the breakout point, the point where middle throw is broken, which means it is similar to projecting price objective of head and shoulder pattern. You can use Fibonacci extension tool to project a 200% extension. Following is a daily chart of CAT Limited, and we saw a double bottom was formed at the level of 500. The level of 500 acted as a support and prices bounced off from this point and broke above this middle throw, broke above the middle peak. A close above the peak suggested that the double bottom pattern is complete. If you were to project a target for this pattern, the distance from the peak to the latest bottom is projected from the peak. So this distance is projected from here towards the upside. So 614 is ideal target for head and shoulder. For double bottom that was formed in CR. Although this is the ideal target, prices don't always tend to respect these targets. Sometimes prices won't reach the target, and sometimes prices won't care about the target and simply break out to make new highs. Hence, it is extremely important that you manage your trade correctly so that if prices reverse on the midway, you protect whatever profit you have made, and if prices were to break out or explode towards the upside or in your favor, you need to manage your trade in a manner where you take maximum advantage of the new found explosion in price move. As you can see here with our example of CAT Limited, although the target projected was 615, that is 100% of from top to bottom, projected from the top to the upside, but you can see prices went all the way till 800, and again the explosion was very spontaneous or very quick. It only took 4 more days to reach the level of 800. And if I was to zoom out a bit more, you can see this double bottom gave result to a much more prolonged upside move, which almost doubled in price. Hence, it is important to use a trailing stop or a trade management method which will help you take advantage of such price explosion moves. So what are the important markers that will help you identify a double top and a bottom? A double top or a double bottom pattern is valid only when prices breach through middle peak or through. So the pattern becomes valid only when prices breach or break out through its middle peak or through. The wider the time it takes for pattern to develop, the higher the profit potential. A perfect double top or double bottom is rare in markets. You will always find variations in price patterns. Sometimes top will overstretch, sometimes bottoms will overstretch, or at other times they will fall a bit shy of testing previous top or bottom. It is important to keep an eye on volume. Second top or bottom must be made on lower or lighter volumes. It is one of the most important rule. Second tops or bottoms must be made on lower volumes, which will suggest you that momentum, that traders are not interested in selling this stock anymore, or traders are not interested in buying this stock anymore, or the interest has decreased towards the upside or towards the downside or towards the previous trend. Whatever the case be, it is extremely important rule to remember that volume on second peak or bottom will be lighter as compared to their previous tops or bottoms. Following is a chart of Dish TV, and you can see prices have somewhat found resistance, support at level of 53, and see here pri prices came down. Only one bar came to test 53, reversed, went up, and then they came down heavily towards 53. And you can see one of them penetrated 53, others were very close to 53. If you were to take a look at this low, you can see this low is lower than its previous bottom. But take a look at volume in this region. You can see volume and compare this volume with volume made in this region. You can see here when prices were consolidating at the level of 53, volume kept declining. And finally, when prices came to the level of 53, volume was almost weaker. And when prices reversed to make a new high, volume picked up. Even though this volume cannot be considered significant, one volume for a day cannot be considered significant. Nonetheless, you can see volume at previous bottom were higher as compared to volume at never found bottom. And then prices reverse. You can see every time prices is spiking up, giving a positive close. That it is doing so on higher volumes. Thus, buying interest in Dish TV is increasing. And then prices break above the top to make a new high. They retrace back to the top. Now take a look at this. Breakout is at higher volume and retracement is at significantly lower volume. Prices come back to test its top and reverse and go ahead to make a new high. So it is extremely important to keep an eye on volume, to interpret volume correctly, to understand whether this is a double top or a double bottom pattern. That brings us to our final revision. We have learned about head and shoulder patterns, inverse head and shoulder patterns, triple top and triple bottom patterns, double top and double bottom patterns. We know that head and shoulder and double tops and double bottoms are most widely formed patterns in market, and these are one of the most commonly traded patterns. So what are the important, we'll make a quick and final revision of what are the important points that must be considered, which will qualify that the pattern is indeed a reversal pattern. First important point is breakout of trend line. The upside zigzag momentum, the trend line can be drawn from the bottom to bottom. The first point is breakout of the trend line, which suggests decrease in momentum. Second important point is the pattern starts to overlap, suggesting a weak upside momentum or starting of a sideways movement. Third point is decrease in volume towards the main trend. Volume start decreasing towards the main trend. Fourth one is breakthrough bottom swing in case of an uptrend. If we are looking for a reversal in an uptrend, the first alarming signal is that most recent bottom is prices break below most recent bottom. And in case of a downtrend, prices break out above most recent top. And last and final point is volume start picking up towards the new trend. So we have learned about most commonly traded patterns and how to determine understand these patterns into formations. That concludes our current tutorial on reversal patterns. Thank you. Next pattern in line is inverse head and shoulder pattern. It is a mirror image of head and shoulder pattern. It is just upside down. In this pattern, there are three distinctive bottoms with middle bottom slightly lower than either of the shoulders, either of the bottoms. A decisive close through the neckline is necessary to complete the pattern. The measuring technique is same, that is a profit target is similar to head and shoulder pattern. Volume plays a critical role in identification of inverse head and shoulder pattern. At bottoms, market requires significant buying pressure reflected in volume to launch a new bull market. It is essential in inverse head and shoulder patterns that volume picks up when prices start to move upwards. Following is a diagram of how inverse head and shoulder pattern looks like. On the left side, you can see prices are moving down and then prices penetrate through its previous bottom, suggesting a decrease in momentum. Prices come down to make a new low at lower volume as compared to its previous low. Prices retrace back to the upside and then prices fall down or try to make a new low, but volumes are significantly lower as compared to the volume that were being made on previous bottom. The next point to keep in mind is prices have broken through the neckline, suggesting that momentum has decreased. So our first yellow signal that momentum has decreased was this top retracing through previous bottom. Remember the rule of a trending market, a zigzag non-overlapping pattern, ideal pattern for a downside moving. A zigzag non-overlapping pattern is conclusive of a trend. So when prices start to overlap through each other, the trend has decreased its strength. So that is our first yellow signal that the momentum of the trend is decreasing. Our second yellow signal comes when the trend line is broken. Trend line is penetrated. Prices clearly penetrate the trend line, moves up and comes down. Our third yellow signal suggests that the downside move, the new momentum towards the downside, is accompanied by lower volumes. People are not interested to sell it to new lows anymore, followed by an upside move on higher volumes. This is very important in inverse head and shoulder pattern, that the upside move is accompanied by higher volumes. There has to be increased activity for prices to move towards upside. Many a times it happens that a head and shoulder pattern is made, but the right shoulder, the upside move for the right shoulder, is not accompanied by higher volume. This will only give doubts about the validity about the pattern. And if create doubts if prices will move towards the upside, if prices will break out to new high. When you see prices are moving upside with increased volume, you are certain that prices have started to go upside, and volume themselves clearly suggest that prices will continue to move upside. So the right shoulder breaks through neckline, which is followed by a reverse, a retracement back to the neckline. In inverse head and shoulder pattern, a retracement is to the neckline is much more common than a retracement to the neckline found in head and shoulder pattern. You will always rely on a retracement to the neckline in inverse head and shoulder pattern. This retracement is made on lower volumes. This is an important point. The retracement is accompanied by significantly lower volume. Going ahead, this retracement is followed by a breakout to a new high. The most important difference between tops and bottom pattern is volume sequence. Volume plays a critical role in identification and completion of head and shoulder pattern. At the bottom, heavy volume is absolutely essential ingredient in completion of basing pattern. The return move is more common on bottoms than on tops and should occur on lighter volumes. Following is a weekly chart of Asha India, and you can see here prices come down, go up, make a new low, start moving upside, come down and break out to new high. So you can clearly draw a neckline. Prices make a new high and return back to the neckline and find support at the neckline. And the pattern is now much more clear as compared. You can clearly identify shoulder, shoulder, a head, a right shoulder, prices breaking above the neckline, and then the return move which retraces back to the neckline only to find support. Once support is found at the neckline and the pattern of head and shoulders is complete, prices resume its upside move. So following is a weekly chart of Asha India. We already saw this chart in our previous slideshow. You can see here where I had clearly tagged left shoulder, right shoulder, head, the neckline and the return move. Here, this chart is accompanied by volume and we will try to construct a head and shoulder pattern which is already there, but still we will see if all our rules qualify, if all our rules set to qualify that this is indeed an inverse head and shoulder pattern. So the first rule is penetration of trend line. A raw trend line, it seems like these two tops will do. Here is our trend line. So once our trend line is drawn, you can see here prices found a resistance at trend line and pulled back, but eventually they broke above the trend line, found support at the trend line and went up, suggesting that there has the momentum towards the downside is changing. Alright, that is the first rule. Our next important rule is taking a look at volume. Every time there is a new low, you can see there is an increased in volume. There is a spike in volume. A new low here, a spike in volume. But when this low was made, you can clearly see there is no spike in volume. There is no increase. This will be our first yellow signal suggesting that something is wrong with this downside momentum. You can clearly see prices broke down so considerably and yet there is no significant change in volume. This is the first signal that something is wrong with this downtrend. Our second signal comes when you can see there is a positive bar and with a spike in volume accompanied by next positive bar also. There is a positive bar, and then prices started moving upside and volume picked up towards the upside. You can clearly see towards the upside volume picked up. So there is no volume towards the downside and volume have picked up towards the upside. Your first and very important proof that prices have changed that momentum. Prices don't want to go lower anymore. Next next signal, breaking of the trend line. And third signal comes when you can see a spike bar accompanied by a spike in volume. So you have a spike bar accompanied positive spike accompanied by a spike in volume. This also tells us that upside has picked up the momentum. Next, there is a retracement. There is a retracement, lower volumes. Once prices start moving towards the upside, volume picks up. So this is an essential element of inverse head and shoulder pattern. There has to be an increase in volume once prices start moving towards the upside. Here it is so clearly evident volume picked up towards the upside and there is an increase in momentum of price picks up towards the upside with an increase in volume. So now we have a shoulder 1 and shoulder 2. You can see here shoulder 1, shoulder 2 and a head, and we can draw a neckline here. So I've drawn a neckline and prices break out above the neckline and retrace back. Now what is important to consider is this retracement. You can see volume has completely dried up in this retracement. Volume is almost negligible. For 3 weeks there is no volume in this retracement. What does this suggest? Traders are no more interested in selling this stock down. They think prices are going up, which was so clearly evident with this green bar. You can see that this green bar or reversal bar was accompanied by stronger volumes. And then prices start moving towards the upside. You can see volume has picked up and prices start moving towards the upside here. Now, if you were to project a target for this pattern, what would be your target? Your target would be the distance from this shoulder to the head. Right? This distance projected towards the upside should be your target. In order to do so, I will use Fibonacci extensions and I'll use a crosshair and project this extension from this top to this bottom. Just go ahead and clear some lines drawn. Alright, from this top to this bottom, from the neckline to the head, draw an extension here and I'll simply select 200% and deselect everything else. Alright, so there is my 200% target. The distance from neckline to the head projected upside should be your ideal target for your head and shoulder pattern. So what should be your entry? One of the most basic entry level should be enter when prices retrace back to the neckline. Okay, that reduces your risk significantly. Enter at reversal and you can use this bottom as your stop loss. This bottom should as your stop loss and this as your ideal target. So this was quite a textbook inverse head and shoulder pattern. You saw breaking of trend line. You saw how volume started acting or started behaving differently when prices made a new low, but volume failed to show any interest in the new low, and then volume started showing interest towards the upside. Then there was breaking of the trend line on higher volume, and then retracement on negligible volumes, suggesting that traders are looking for the upside in this stock, and then prices reverse and make a new high. Our next pattern is triple top and triple bottoms. Triple top and triple bottom is a variation of head and shoulder pattern. In this pattern, it is just that the head and both the shoulders are in straight line or are at equal levels. All the rules applied to head and shoulder pattern is applicable to triple top and triple bottom patterns. Volume interpretation for triple top and triple bottom is similar to head and shoulder pattern. The only difference is triple top and triple bottom patterns have three tops at similar levels or three bottoms at similar levels. Following is a diagram of an ideal triple top pattern. The volume interpretation is similar to how you interpreted volume for formation of a head and shoulder pattern. The trend line break suggests that there is a decreased momentum towards the upside. The penetration of bottom into previous top, giving an overlapping of waves, suggesting that the upside momentum has decreased. The only significant difference between head and shoulders and triple top is the top formation. All three of the tops are somewhat at similar level. You will not always find three tops at exactly same point. There will always be a variation as markets are traded by people and people tend to trade most of the time with emotions. You will always find a bit of over exaggeration of the price move or price move sometimes falling short, but nonetheless more or less prices tends to finding resistance or forming tops at same levels. At the same time, as with head and shoulder patterns, you could draw a neckline clearly. Similar is the case with triple top pattern. You could draw a neckline clearly. Once a neckline is broken, the pattern is complete and suggests that this is the formation of a triple top pattern. Breaking of neckline is followed by a retracement back to the neckline on weaker volume, and then prices find resistance at neckline and start falling down to fresh lows. So the pattern overlapping, trendline breakout, neckline breakout, retracement to neckline, every and interpretation of volume. All these points are similar to head and shoulder pattern. The only thing that differentiates triple top with head and shoulder pattern is formation of top at similar levels. Now that we have seen triple top pattern, next we'll see triple bottoms. Triple bottom has shares much more common features with triple inverse head and shoulder pattern. Even in bottom patterns, volume interpretation holds true as volume interpretation was important for head and shoulder inverse head and shoulder pattern. All the rules that applied to formation of an inverse head and shoulder patterns apply to a triple bottom pattern. The overlapping of wave structure suggesting decreased momentum towards downside, the decrease in volume at every low, the increase in volume when prices starts moving up, the breaking of the neckline, and then the retracement back to the neckline at lighter volumes, which finally completes the triple bottom series. The only difference with head and shoulder patterns is head and shoulder has a lower low accompanied by higher low on either side, whereas triple bottom pattern has low of equal level. Following is a chart of Blue Star Corporation, and you can see here prices have found resistance at the level of 370. There is no head and shoulder pattern as each high was successfully higher than its previous high. Nonetheless, prices could not sustain to the level of 370. And if you take a look at volume, with increase in price, there was increase in volume, a decline followed by low volumes, a new high with fresh volume, again a decline followed by lower volumes and a fresh new high. But you can see volume is lower as compared to the volume that were being made at its previous high. Although this is a new high, but volume is lower as compared to volume at this high and as compared to the volume at this high. So although high is being made, but volume is gradually decreasing towards the upside. Now I'll clear all the studies here. So this is somewhat a high is being made at a constant level, and you can see a clear neckline here. A trend line can be drawn from point A to point B, break through the trend line suggesting a decrease in momentum, a new high on weaker volumes, prices start falling down and break through neckline. Although break through the neckline is not at higher volumes, but a retracement back to the neckline is not at higher volume, suggesting that upside prices are not interested going upside. Maybe prices don't want to go downside right now, but they are not interested in going upside either. So price and volume interpretation of a triple top is similar to the price and volume interpretation of head and shoulder pattern. Welcome to our new tutorial, reversal patterns. In this tutorial you will learn some of the widely traded reversal patterns in the market. You'll learn about head and shoulder patterns, how to identify them. We'll learn about triple tops, triple bottoms, and double top and double bottom. Let's quickly go through the contents. That is introduction, and then head and shoulder patterns, followed by inverse head and shoulder patterns, triple top, triple bottom, double top and double bottom. So introduction. After a prolonged trend, market tend to change direction, or market tend to start moving sideways. This change of direction or this change of momentum sometimes is a gradual process, whereas sometimes changing direction of market trend is abrupt and rapid. It is generally observed a top reversal is volatile and quick. Every time you will see formation of a market top, you'll see the reversal from the top is quick, more volatile, and travels at a more speed. Whereas if you take a look at bottom or formation of bottoms, it takes time to build bottoms, and whether a bottom is made or not, in order to identify that, you will have to depend a great deal on volume and its interpretation. So in this tutorial, we'll learn about most commonly found reversal patterns and how to identify them. Our first reversal pattern is head and shoulders pattern. As the name implies, the pattern looks like a head between two shoulders to either side. It is a situation in a major uptrend where a series of ascending peaks and throws begin to lose momentum. By now, I believe you already know about peaks and throws and quality of an uptrend. In an uptrend, you will have non-overlapping upside moving zigzag waves. So head and shoulders pattern is formed when a non-overlapping upside zigzag wave begins to lose its momentum. So when does a zigzag upside wave starts losing momentum? That is when the non-overlapping patterns start to overlap. So when it starts to overlap, the uptrend tends then levels off for a while. The uptrend takes a breather. That is what we call it, a breather. The uptrend halts for some time or levels off, it ceases to move upward. During this time, forces of supply and resistance are in relative balance. When uptrend ceases to move upside and starts to move sideways, forces of supply and demand are in balance, because when prices were moving up, demand was greater than supply. Now that the prices are moving sideways, which means demand and supply are balanced. Once distribution phase is complete, support level support levels along the bottom of the horizontal trading range are broken and a new downtrend is established. That new downtrend now has descending peaks and throws. Let's take a visual example. Following is a diagram of an ideal head and shoulder pattern. The zigzag lines are prices and the straight lines drawn are called trend lines. Below, this is the volume traded for each day, and prices are written for reference. So let's start from our left side. You can see prices are moving higher in a zigzag pattern, with each peaks and throws going up in an ascending pattern or an ascending manner. Now, if you were to look at the volume, every time prices make a new high, the high is made on increased volume, whereas when prices retrace back, volume decreases. When prices resumes its uptrend, volume starts to increase. Retracement is followed by weaker volume, again an uptrend on not so higher volume. You can see this uptrend was supported by a stronger volume, whereas this uptrend is not supported by that strong volume. Volume is weak as compared to its previous uptrend. This is the first red signal that suggests that something is going wrong with current uptrend. The dynamics of current uptrend has started to change. Now this uptrend on weaker volume is followed by a slide downside, which is sometimes at comparative higher volume as compared to previous sliding, or sometimes it shows no significant changes whatsoever. But what is the first yellow line that will tell you something is wrong with the trend? Is new high is accompanied by weaker volume, followed by a retracement back. Nothing is wrong with the trend. But one of the most important point to note is this downside retracement has retraced too much into its previous peak. This retracement has retraced too much into this previous peak. Now, one of the basic rule of an upward moving market is non-overlapping upside zigzag patterns, whereas here it has overlapped significantly into its previous top. Whereas if this retracement was to be compared with its previous top, you can see the retracement is negligible or very less. But here retracement is more than 50% of this range. So that is another important point to keep in mind, that the retracement or overlap is considerably large, which is followed by an upside momentum. Now this upside momentum you will see is clearly on weaker volumes as compared to its previous top. So when prices starts to stop going more upside, or when prices have started to move sideways, you will see the upside momentum. On upside momentum, volume start to decline. So volume plays an important role in identification of head and shoulders pattern. So this upside momentum is accompanied by further decrease in volume, which is followed by a downside move on higher volume or increasing volume, followed by upside move on decreasing volume and downside move on increasing volume. So the dynamics of volume supporting the move changes completely when the pattern reverses. Here, volume was increasing every time prices was moving up. Here, volume start to increase every time prices start moving down. Sometimes you won't find such clear patterns accompanied by such clear increase and decrease in volume. The formation of top or the formation of head and shoulder pattern is clear. Every time a top is into formation, you will find volume decreasing. Every time a neckline or an important level is broken, you will find volume start to pick up in the opposite direction. Now this line is called trend line. The idea of drawing this trend line is to understand the momentum of upside move. You can see here the trend line is drawn correctly, clearly, and after point C, the retracement breaks its trend line, or the retracement retraces more than its given momentum, suggesting that the momentum has changed, or the momentum towards the upside has weakened, and then it goes up on alarming lower volume, which suggests something is wrong with the upside move. So when point D is created, when prices have moved up or closer to point C to test the top or to take out to a new high, when that is being made, point D is clearly created. So all you have to do is draw a trend line from point B to point D. This trend line is called the neckline. When prices have moved to point C, point E, you draw a trend line from point B to point D. But the pattern is still not complete. The pattern qualifies to be a head and shoulder pattern when prices break below the neckline and gives at least a 2 bar closing or a 2-day closing below the neckline. Only then the pattern can be safely assumed to be completed. Now, after the breaking below trend line, it is always seen that prices tend to retrace back to the neckline. Prices tend to retrace back to the neckline, and after finding a resistance at neckline, price starts dropping down. This is a very known and common phenomena. This is one of the most important and always seen in a head and shoulder pattern that after breaking the neckline, prices tend to retrace back to neckline to test, finds resistance at neckline, and then reverses into its newfound direction. But not always you will find the retrace back to the neckline, especially when the downside move or the downside momentum is made on greater volumes, which shows that there is more pressure towards the downside. As a result, you won't find a retracement in such a case. Every time a retracement is made back to the neckline, that retracement is made on weaker volumes, which is again a signal that upside momentum has faded out and a new downside momentum has started. Following is a chart of GMR Infra, a daily chart, and this curved yellow line is called Fibonacci arc because every time this chart found a superb support at this arc, I used this arc to find support and resistance zone or to draw a curved trend line. We can safely assume that this curved trend line worked. As you can see, it found support at this curved line at least 3 to 5 times in its upward move. Now the first thing to see is every time prices make a new high, you will see the high is accompanied by higher volume. Every time price made a new high, it is accompanied by higher volume, and every time prices retrace back, see how volume contracts, suggesting that people are not looking to sell or get out into the stock just now. They want to hold on to the stock, right? Then you see a blast in the volume with new high, new high, supported by higher volumes, retracement, shadow zone supported by decreasing volume or decreased volume. So a new high followed by increased volume. Then prices fall down on increased volume. You can see here prices fell on increased volume, uh, spend some time, retrace themselves, and then prices start rising up. But this upside rising is made on weaker volumes, you can see here. And then price dropped abruptly to break below the trend line of 32. This 32 trend line of 32 was drawn because this bottom was clearly on the line of 32 and this bottom was also on the line of 32. So it is safe to draw a straight trend line at the level of 32 instead of taking this low into consideration. So you can see prices started moving up but on weaker volumes and then prices came down to break below the trend line on increased volume. What does this suggest? Downside move has picked up volume, suggesting that the trend has started to reverse. We don't know as of yet, but our pattern is almost complete. You can see there is a clear left side shoulder ahead that is higher above both the shoulders. Prices have retraced back and there is a right shoulder. When prices fall below, it confirms the neckline. This is the neckline. As a human body has a neckline, that is the start of the neck. You can see it also has a neckline. So once prices broke below this trend line, prices retraced back. As I have said in my earlier diagram, prices tend to retrace back to test the neckline. And this retrace or this upside move is on weaker volume. Here you can see prices retraced upside to test the neckline, but the volume was considerably low, suggesting this confirms that prices have found resistance at the neckline and upside momentum has ceased, which is followed by a straight downside move. So, what are the important points of head and shoulder patterns? The first part of head and shoulder pattern is an uptrend. The left shoulder of on heavier volume, that is point A, followed by a corrective dip to point B. A rally into new high but on lighter volumes. A decline that moves below previous peak at point A and approaches the previous reaction low, point D. A third rally, a noticeable low volume that fails to reach the top of the head, a close below the neckline, a return move back to the neckline followed by new lows. Here, rally to new high on higher volumes followed by a decline. Then rally to new high on lighter volumes followed by a decline that lasts significantly below previous top. Then a rally attempt for a new high but on weaker volumes. Then a breakdown below the neckline drawn from B to D. After the breakdown, prices retrace back to the neckline. In this case, I have not drawn, but generally you will find prices retrace back to the neckline on weaker volumes and then prices reverse and start falling down. So what are the most important rules that identify head and shoulders patterns? First rule, there are three well-defined peaks. You will clearly see a well-defined peaks in the charts. Second, middle peak is slightly higher than either of the two shoulders. Third, violation of a trend line. When trend line is broken in the upside momentum, this suggests the momentum is weakening. Hence, violation of trend line is an important that gives you an idea that upside momentum, there is something wrong with upside momentum. And fourth, penetration of prices below the neckline. When neckline is drawn from bottom point of B to bottom point of T, you will find prices go ahead, fail to make a new top, reverse and fall below point T. Now that we know how head and shoulder pattern is formed. What should be the minimum price target? If we enter into a trade, in order to identify the minimum price target, all you have to do is measure the length of last top. Measure the length from head to neckline and project that distance from neckline to the downwards. If you're using a Fibonacci extension tool, use 200% extension from head to neckline. We're back to the chart of GMR Infra, and you can see here this is was our neckline and this is the head, that is the highest point in this pattern. So what I have done is used a Fibonacci extension tool in AMI Broker, extended this range downwards. That is, if this is 0 and this is 100%, then I have plotted 200%. That is the equal distance of this from point this. So 200% comes at this level, and this is the general profit target while trading this head and shoulder pattern. When downside momentum is strong, you will find prices penetrating 200 level straight and moving straight downside. No matter what the situation, all you have to do is manage your trade correctly, and I'm sure this pattern will be profitable. Now that we know what is the minimum price objective, what should be the entry? What should be the entry price? Most traders sell at the breakout of neckline. Once prices have broken below the neckline and gave a level of closing below the neckline, they tend to sell that itself, whereas others wait for a retracement back to the neckline once breakdown is made. So these are two entry levels, entry methods that are commonly used by traders. Some sell once prices have broken below the neckline, others wait for the retracement back to the neckline before initiating their short position.